All right. Once again, good evening, everybody. Welcome to our boot camp. Let's go down the rabbit hole. Let me disable annotation, right? So nobody annotate on the screen. All right. Okay, so you're welcome once again. Let's go down the rabbit hole. My name is Philip, like I stated initially, and I'm happy to have all of you here. I'm grateful you are here. I do not take it for granted. Thank you for being here. So without wasting so much of our time, let's get down to our psychology training. Probably maybe I should start off this way. Um, there's a reason why we are incorporating psychology into our calls. Give me some minutes. So there's a reason why we're incorporating psychology into our training, and I think I stated it yesterday. If you are not on the call yesterday, well, you're welcome. Happy to have you again. Is because we discovered in recent time that trading is purely beyond the chart. Of course, we are going to do a lot of chart work. There is a way to trade. There are specific things we look out for on the chart, but we discovered that because what we are handling is money, like real money is what is being traded, and like I think you all know that about 5 million US dollars, I guess, if I'm not mistaken, 5 million or 5 trillion US dollars is being traded in the forex market every day. Trust me, if you want to hold that capacity of money, there's a kind of mindset you ought to have, because I'm pretty sure some of us will hear the saying of money changes people. People change when they have money. It is true, whether you like it or not, it is true. Some people change for the better, some people change for the worst. But I'm not about to talk about probably changing for the better or for the worst. I'm just trying to bring up to our notice that really you want to be at a very good state of mind for you to hold or have certain kind of money in your hand. And this thing starts with your mind. I think one of my educators is always going to tell you that there's always the power of the mind, or one of my coach or my mentor is going to tell you there's this power of the mind, and if your mind is in a wrong perspective or a wrong shape, it is actually going to reflect on your chart or on your trading history. For instance, For instance, I think some few weeks back I was on a call with one of my mentors, Zachary, and he was talking about what you see on the chart, that no matter if the chart is buying or selling, or either you are taking a winning or a losing trade, all of it is just your mind that is reflecting on the chart. So if your mind is really not in the right perspective, you necessarily might not break through or not get good results on your chart. And this is the reason why we are bringing this psychology calls to you. Having said all of that, I want you to know today that, you see guys, when it comes to Forex, I hope I will not be insulting anybody or trying to down talk anybody. I'd like you to know that when it comes to trading, you see, every single person that is an educator here, and most of my coaches are even in this place. Shout out to my coach, Tony Blend. Trust me, every single one of them have experience in trading, bitter experience and sweet experience. Now, when they start telling you, you discover that they have to come from a place of zero knowledge or trading the wrong way. I think one of the example my coach Tony is going to tell us is when he started trading this crash and boom asset. I'm pretty sure some of you know synthetic indices. So he started trading crash and boom, not knowing the analysis today, just discovered that he was trading, I think, crash, and you know that crash spikes down when they sell again. print a buy candle for some minutes or some hours. So he just discovered that his account was on so amount, and then he just pressed buy, and he discovered that, oh my god, look at this. I found the assets, and it kept on going up, kept on going up. He didn't really know why it was going up, didn't really know why it was coming down. And all of those losses he made actually pushed him to knowing how to trying to figure out how to trade the right way. Trust me, there is a way to trade the right way, and there is a way to trade the wrong way. Now, I do not claim, or we do not claim to know it all, but we are trying to tell you that from what we've seen or from what we've been experiencing, we've been having some consistency or some level of consistency to be able to tell you that there really is a way to trade right. I think earlier today on the group, I dropped two assets or two trade trading assets or trading signals, or how do I put that in the right context now? Two trades. Let me put it like that. Two trades that we took, and both trades were winning trades. Now you necessarily discover that most forex trader, we don't share our losses with you. So it might be like, okay, they are only sharing their winning trades so that we'll know that they are profitable and they're not losing. Trust me, we are not crypto guys that buys the dip. As traders, we experience the two on a regular basis. And this is the reason why we have risk management, which is also going to be taught during this training. Now, I said all of that to tell you that, you see, for us to be able to predict the markets to that level of certainty or perfection, it didn't happen overnight. And permit me to even break your heart, it didn't happen in 5 days. Yes, we are going to teach everything we know in 5 days, but there is a place for consistency in our learning, or a place of experience that we've actually incorporated into this thing. So you could learn everything in 5 days, but trust me, I'm going to be telling you the truth that don't think maybe after the 5 days that your trading is just going to change and then you're not going to be making any losses again. Or maybe, trust me, you need to experience these things yourself. And this is the reason why we are here, to give you this for the 5 days. And then probably as you go on, you keep on watching, you keep on training, you keep on mastering the skill set. You keep on developing yourself over time for you to experience this consistency in winning. But all of this will not start if your mind is not in the right perspective. Some people just want to make money to show off that, okay, I'm rich. Some people want to make money to show off, to do so many things. The idea now is, why do you really want to make money? Sometimes you should sit down to ask yourself that. Again, another thing you should think about is, some people as well, they've now concluded that they want to be in this trading game for long. Like I said yesterday, if you want to last, you must prepare to last long, right? I think one of my older mentors, L. Nightingale by name, said something about some people, they don't think about their wealth or their finances in a long-term perspective. The question is, I think most of us on the call, we are still youth, we are still teenagers, young adults. The idea now for me is, have you sat down to really think about it, that in the next 30 years, where do I want my finance to be? In the next 20 years, where do I want my finance to be? In the next 50 years, where do I want my finance to be? Am I in this game to make this money in 5 days or in 1 year? You understand? And if you don't have all of this in mind, losses will start beating you down. You understand? If I'm planning that for the next, let me say 1 year, I'm going to be trading. If in the first month of my trading, I experience losses all through, come on, I still have 11 more months to really go down. So why should I be so agitated that I'm making loss in the first month? I don't know if I'm making sense to some of you guys. If I'm really making sense, can you drop something? Right. All right. Thank you. Thank you for your participation. So tonight, my major word for you is: are you really prepared to be rich long term? Not short term, long term. If yes, that you are prepared to be rich long term, have you put a strategy together in your mind to falsify that very decision you made? And believe you me, some people have not decided to be rich. Some people just decide that they want to make money. They've not decided to be rich and wealthy. They are not the same thing. You can decide to make money today, and tomorrow you lose that money. But you see, if you are not rich in your mind, or in your mind, and you are not wealthy in your mind, no matter the amount of money that comes to your hand, you are still poor. You are still broke. You still don't have this money. So wealth creation starts off from your mind, not from you having your 1, 2, 3, or flipping your $100 account into 10K. It doesn't start like that. It starts with your mind. And anything that starts with your mind starts with the kinds of things you think about, starts with the kind of things you talk about, starts with the kind of people you roll around. So that I don't waste so much of our time, I would like to welcome my first educator. His name is Ayo. Ayo is reaching out to us from Ogun State. So I would like to stop my screen now and stop my music, and then make Ayo the host. Yes. All right. So Ayo is now the host. So Ayo, you're welcome. Thank you for having me today. Over to you. Just do your thing and let us add
right. Good evening, everyone. Good evening. Can you all hear me? Drop some words if you can hear me, please. Good evening. Good evening. All right. Let's go. Well, shout out to Boss Philip. I really appreciate this. I did not take it for granted. And I can see one of my grand mentors on the call, Coach Tony. Good evening, boss. Good evening, boss. Thank you for hopping on. All right, without wasting much of our time, let's get into it. Okay, can you see my screen now? Let me know if you can see my screen. Okay. Well, I hope you all enjoyed yesterday's class. Thanks to Baby Boy and Boss Tokbe. So without wasting much of our time, because we have a lot to cover today, let's get into it. So we have our syllabus on the left-hand side. Right here, we have what our forex candlestick, applications needed to trade the forex, what's a broker, different type of brokers, understand the trading view websites, difference between the standard trading view and trading view for binary, how to take trade from trading view. Okay, so let's start with the candlestick. When we are talking about candlestick in the forex market, we only have two types of candlestick. We have that of the buy candle and sell candle. So I'll be explaining with some charts. Okay, let me make this green because I believe most of our buy candles are green by default. Let me put it that way, by default. All right. All right, so this is what a buy candle looks like. This is what a buy candle looks like. And for us to determine a buy candle, a complete buy candle, there are some certain things that have to be in place, such as we need to have the open of a candle, the close of a candle, and the wick of the candle. So right now, let me identify for us to see. For a buy candle, this is the open. Because when we are talking about something that is buying, it means that thing is going up. It means that thing is going up. So this is the open of the buy candle. All right. And this will be the close. This will be the close of a buy candle. So you see this tiny wick that we have to downside, we call it wick. This thick like this. Is it black enough? Okay, it's black enough. We call it wick. So what it means that at a certain point in time, the market sold all the way down here before pushing back up. So market opened at this region and then sold all the way down here before buying all the way up. So this week that we're looking up to the upside means that the market bought all the way up here, then sold a little bit down before closing. So this will be our low of the candle, the low of the candle. And this will be the high of the candle. All right, so this is the eye of the candle. We call this stick here, we call them wicks. I don't know, let me try and identify that also. We call them wicks or shadow, either ways. So it means the wick. This is what the stick means. So now let me try and draw what a sell candle means. So I'm going to identify this with red candle and then okay. So this is a sell candle. And when we are talking about a sell candle, it means that that thing is going down. It means that it is going down. So this will be open right here. It's just like the opposite of the buy candle. This will be our open, and then this will be our close. If you are still with me, can you drop some 111? So maybe, I don't know if I'm too fast or it's all good. Okay. So now, for us to have a complete candle, we need to see the low and the highs of that day. So this will be our what? Can anyone drop it in the chat? So I want to know if you guys are following. That will be our what? What is this week going to be? No, it's not going to be the open. Now I'm talking about the weeks. I'm not talking about, okay, let me just start over again for you to understand. Now this is the open of a sell candle, and this is the close. This shadow here, this week here, what is it going to be? What is it going to be? Thank you. It's going to be the high. It's going to be the high. This will be a high. Am I right? No. Yeah. That should be a high, right? That means, oh, that means when the candle opened, it bought all the way up to that side. Can you see? It means that it bought all the way to this side before selling down. I'm going to show you practically on chart before selling down. So now this is going to be our low. the low of that candle. I hope you understand now. And then this is going to be what? The wick. So this is a complete candlestick pattern. This is a complete candle of a buy and that of a sell. This is how it looks like. There are some cases that you can see a candle without wick. That is more advanced. We call it imbalance. But right now, for a candle to be a complete candle, this is exactly the things that you want to find in that candle. So let me open another to show us practically what I'm trying to say before we move to the next topic for the night. Okay, so for better understanding, I'm going to change the color. This will be red, and then okay. Okay, so now let's look at this particular candle here. This candle is a buy candle. This particular one. Can you see this particular candle? That is a buy candle, and you can see that when it was buying, market was initially selling, but then it opened here, sold all the way down to this week to give us the low of that candle, and then bought all the way up here. And bought all the way up here, then came down a bit and closed here. So now this is the wick, this is the high of that candle, this is the low, and the open is here and the close is here. I hope you understand up to this level. Just drop some 111 if you understand to this level. Drop some 111 if you understand to this level. Okay, that's for the buy candle. Now let's look at the sell candle. Look at this region here. This is a sell candle. This is a sell candle. You can see that the market was selling, but when it got here, it pulled up, put to the upside a little bit. There was a buy here, but the candle did not end as a buy candle. It later sold down and gave us this wick to the downside. So now this is the high and this is the low. The market opened here and closed here. I hope you understand to this level. So basically, these are the two types of candle that we have in the forex market. Basically, these are the two types of candle that we have in the forex market. So now let's move to the applications needed to trade the forex market. We have two types of application that we use to trade the forex markets. We have the MT4 and we have the MT5. So I'm going to show you what they looks like. So you can just Google to see it. MetaTrader 4. And I think this is how it looks, this is how it looks like. You can see it. Can you see my screen? This is how MetaTrader 4 looks like. And you can find this application, either use it on your system or on your phone. If you are using Android, you can find it on your Play Store. If you are using iPhone, you can see it on your Apple Store. And we also have that of the five, just like another app, but it's just the same from the same company. Okay, this is how MetaTrader 5 looks like. You can also find it for those that use Android, you can find it on Play Store, and you can also find it on Apple Store for those that use iPhone. I hope you understand to this level. So these are the two applications that we use to trade the Forex markets. So now let's move to a broker. What is a broker and different types of broker? Basically, for me, I think we have a broker is just like someone that stand as a middleman between the retail traders and the big boys, the banks, the institutions. That's what it basically means. Because we do not have this Forex is designed for the big boys to play with, you know, the likes of JP Morgan and the rest. This chart and the central banks, this chart is designed for them to play with. We do not have that kind of amount to say, okay, we also want to trade in this Forex market. But the broker has given us that advantage, that privilege to have access to this chart with a little amount of money and giving us that grace to leverage on their own fund, giving us that advantage to leverage on their own fund to trade the financial markets. So basically, we have different types of broker. There are a lot of brokers. We have that of prosperity brokers. We have hot forex broker. We have FS choice. We have Derrick. Derrick is also a broker. I know that some of us that trade synthetic. Derrick is also a broker, but they are just like there's an aspect of Derrick that you can use to trade synthetic, which you cannot find on other broker, because synthetic is designed to only be traded on what's on Derrick. You cannot find it. Maybe if you try to use maybe prosperity broker, you cannot find it there. If you try to use hot forex, you cannot find it there. So it's only there that give us that advantage to trade synthetics. So that's it about broker. And there are a lot of things that you need to watch out when you're talking about brokers, the likes of the what's it called forgotten now. When you want to compare, you need to look at that their spread, in terms of, you cannot just say, okay, I feel like I want to use this broker. You need to know about their spread, about what the company is all about, what they offer you. You need to check everything. Don't just say you want to use this broker. You need to know the type of broker you are using and how it operates. So that's that. And understand the website trading view. Understand the trading view website. Basically, we have two types of trading view. We have two types of trading view. So there's that of what's it called, that you can use to trade the financial markets. And just okay. So all right. Sorry for that interruption. So this is a standard trading view. This is a standard trading view. And the other one is, where is it now? Okay. This is a standard trading view. This is the one that used to to analyze the currency market, the currency pairs, and to see maybe you are trading indices or crypto, whatever you are trading. These are the standard trading view that you can use to analyze the market. The second trading view that we have is that of the binary. So if you want to look for that one, you just type in trading view, binary. So when you type in trading view binary, then come to trading view implementation for binary.com. So this is how it looks like. Let me just try and change this to something that we can all understand. So now on this trading view, you cannot find anything like that of the currency pair. Can you see? You can only find out of the what? Indices, synthetics. Here it is. So you can find all this on the trading view binary. This is how you know the website is different. The website is different. So you need to save it for you to understand how it works. You need to save it to understand how it works. So moving on, we have understanding trading view websites. Okay, so now I'm going to teach you understand trading view website, and difference between the standard trading view are just like I need to do the two together. I need to do the two together so that you understand what it means to use the standard trading view and the trading view for synthetics. So now when you open your standard trading view, this box here, you can use it to select, maybe you want to trade the forex market. You can use it to select and search for any forex currency pair that you want to look for. You can just type in the currency pair that you are looking for, and it's going to give you a lot. Can you see? If you want to trade USD, JPY, USD card, anything, is going to display it for you. So this is what that box represents. That's what it represents, for you to search for any symbol, anything that you want to trade on. That's what it stands for. And here we have the time. What this time means that the time frame, we have a lot of time frame here, but starting from here, you can see that we have that of monthly, weekly, daily, H4, 3 hours, 2 hours, 1 hour, up to 1 minute. And there are sometimes that if you pay for the premium trading view, you are going to get the seconds time frame. You are going to get the seconds time frame. So this is what it stands for, the time. And right here, you have that of the candle. This is maybe you are using the normal candle. This box here, the bar style. So we have the bar candle, we have the candlestick, we have the Halloween candle, and the rest. But for this call, you should be more focused on the line charts and the candlestick pattern and the candles, that of the candlestick. You should be focused more on these two, because these are the two that we use most of the time to trade the forex markets. Then we also have what's this indicator templates. This is like if you want to add any indicator into your charts, you can get it all here. You can get it here. Just type in the indicator that you're looking for, then you get it. We also have the alerts. This alert works, maybe you are trying to take a trade and you are looking at certain points, certain level in the market, that when market gets there, maybe you are going to be busy, you want to get a notification from trading view. So just make use of this alert and input the number of the price. So when price gets that number, it's going to alert you, it's going to trigger and alert you to let you know that okay, price at this region. Then you can come up to open your laptop. Okay, let me now reanalyze or take a trade. So this is what the alert works for. That's the work of the alert. And right here we have the bar replay. The bar replay is for those that have paid for the premium level, premium trading view. Maybe you are using it for this back testing, so you can just cut certain candles out and then look at how it plays out. So this is what the replay bar, that's what it works for. And right here we have the undo and redo button. This is an example of the undo button. You can see this trend line. If I do not want it, maybe it's just like a mistake, but I do not want it on the chart, I can just press the undo button, and then it will be off. Or maybe if I need it back, I can just press the redo button, and it will appear again. That is what this side, that's what it is for. So right here, maybe you want to save your chart, you want to screenshot, you get it all here. You get it all here. You can see save charts, copy chart image, chat link. Maybe you want to send it to someone, you can see everything's down here. So just click it and then you are good to go. Right here, we have a lot of, these are just the tools that we used to trade, the tools that we used to trade. You can see the cross, just like the cursor. If you want to move anything on your chart, you can use the cross, the dots, the arrow. You can pick anyone you like. This tile means that you want to make it your favorite. And when you are making it your favorite, it's going to display down here. All the tools that are displaying down here, I already made them my favorite. These are the things that I work with. So you can have more than that, and you can have less than that. Right here, you can see that trend line, arrows, ray, anyone that you want. Whenever you want to mark up your chart or to know what is going on in the market, and this really works for the technical analysis guys. And most of what we do is based on technical analysis. And right here we have our feed. You can see all types of feed. You are going to see everything down here. So you work with it, play around with it. Basically, this is just the tools. This is just the tools. And right here, you can see maybe you want to look for long position, short position, price range, anything. You are going to see it down here. So play around it for you to understand better. If you not play around it, you will understand better. Play around it to understand better. So it's not that much different from, this is standard trading view. It's not that much different from the trading view for derivative or the binary. We also have that of what? All that of the volatility index that you are looking for. You are going to see it here. Can you see? You are going to see everything here. And then beside it, we have what? We have the time frames. Now, the difference now is that when you are using the trading view for binary, we only have from the 24 hours down to the 1 minute. Remember that of the standard trading view, we have from the monthly, we have from the daily, monthly, and the rest. And we also have that of the yearly, 2 months, 3 months. You can find the up to 1 second. But down here, you can only see that of 1 minute and 24 hours. That's the day candle. You can't go beyond that. I can't go less than that. And these are also the candlestick pattern that you can use. Maybe you want to use the bar chart, the candlestick charts, anything that you want to use, the line chart. But basically, this is what it is being used for. Now, using the compare to, I'm not sure that it has ever worked on the reef, because it has to divide your screen, but I don't know. To me, I do not think it works. Okay, it works. But then you can see, we do not use it because there is no currency thing. When you are using the type currency standard trading view, you can compare between the two pair to know what is going to happen in one asset and the other. But here, when you are trading synthetic, you can't compare anyone, because what they do is different from each other. What they do is different from each other, so you do not need to compare. And right here, we have the indicator where you can find your, maybe you are using Boliga bands, you are using RSI1, you are using what's it called, relative strength index, oscillator, anything that you are using, you can find it down here. So you just mark it, then input the figure that you are looking for, and you are good to go. Here we also have the redo button. Okay, I'm coming. So right here we also have the redo button. 1 second, please. All right. So now this place you also have the redo button. Like I showed us on the previous charts. Maybe you made a mistake and you want to try and correct your mistake. Can you see? Maybe you are not, you made a mistake and you want to remove it. You can just press the undo button. It's going to disappear. Or maybe you made a mistake by deleting it and you can just press the redo button. It's going to come all the way back here. So right here, you have, maybe you want to send out your chat link. You can copy it and then you send it to whoever you want to send it to, or maybe you have a group that you are saving your chat markup to, then you just send it there. And right here, we have the what? We have the chat properties, we have the save chat button. Maybe after doing all your markup and you want to shut down your system, you can just press this side and it's going to save everything down for you. So when you come back, you are going to meet all your markup, you are going to meet them there. And right there is also the toolbar. Everything that you need to trade to use for your technical analysis, you are going to find them here. And you can see this star sign is to add to favorites. If you need them on your favorites, you add them to your favorites. That is what they all stand for. Also, let's see what next we have on the class. Now we have talked about the difference between the standard trading view and the trading view. Now, how to take trades from trading view. How to take trade from trading view. Let me start from synthetics. So now this is where you can find your long position and short position. Long position means that you want to buy. So when you click it, then this is how it's going to display for you. This is how you're going to see it. Or okay, let me set it to default. So we can all see how it's going to display. All right, so this is what you're going to see. So now this stops means this red part, it means your stop loss. And you can see that if each time I move it, this figure is going to change. So this figure, like we are taught about pip yesterday, it represents pips. So this is 110 pips. And here is your risk to reward. This is your reward. This green part is your reward. And you can see that, okay, maybe you are risking 1 to 1. This is how 1 to 1 looks like. Exactly something like this. This is how 1 to 1 looks like. But we are always going for the first target is 1 to 3. So if I'm risking 100, then I'm looking to get what? I'm looking to get, if I'm risking 110, I'm looking to get what? 331 pips out of the market. This is what the long position, this is what it represents. And then the short position, this is how it looks like. Just like the opposite of the what? Of the buy position. So this is where your stop loss is. It means that if price traded into this place and beyond, your stop loss is going to get it. Okay. I'm going to throw more light on the standard trading view very soon. All right. So this is what it means then. This is your what? This is your profits. It means that if the candle trade all the way down here, you would have gotten a 335% pips off the market. And your take profit is going to get it. So this is what the long and short position mean. So someone dropped a question that I should explain more about the standard trading view. All right. So can you be specific about what you do not understand about the standard trading view so I can know what to talk about, please? Is the person still on the call? Mr. Ahmad. Okay. How to use the tools such as trend line. All right, all right. So now this is what this is standard trading view. These are all the tools. So we have the trend line here, we have the arrow, we have the ray, and so I'm going to explain one after the other. This is trend line. If I want to mark like something like this now, this is one of the ways that we make use of the trend line. This is one of the ways that we make use of the trend line. I hope you understand. This is how you make use of the trend line. It's just to connect 2 points or 3 points or 4 points in the market to connect it together. That's what the trend line is being used for. And we also have what the arrow. Maybe you are looking for a break or structure. So now with this, you know that okay, there's a break or structure somewhere. That's how we make use of the arrow. This is what we call the brush. Maybe you are looking to draw your, just visualize your, what's it called, your structure. Oh, the brush. Was okay, yeah. It's correct. I think I was too fast. So now this is the brush. Maybe you are looking to make to for your um structural point, yeah, structural point. Then you can know that okay, this is the brush, and then just on and on like that. That's what to make use of the brush for. And this is also the long and short position. The fib, okay, you have the fib. The fib is when you are connecting 2 points together in the market, your swing high and your swing low. And we have some numbers in the fib that we make use of. We have some numbers that we make use of. You can go to the settings to adjust the number to whatever you want. I hope you are with me, Mr. All right, this is it. So you can see we have a lot of numbers in the Fibonacci level that you can make use of, but these are the ones that I use. These are the ones that I use. Yeah, there's a guide to how to use the trend line when you are doing your analysis. There is a way because before you can take a trade, you know that there are some certain things that should be in place. So those things will let you know that okay, this place now, what I need is a what I need is a trend line. This place, what I need is a what I need is an arrow. And we also have what is called rectangle. Maybe for those of us that use support and resistance, this is how you draw it to know where the support is and where the resistance is. Or some of us that use it for points of interest. This is how we use it. This is how we make use of this. Okay, so now on this side, well, this is what I just used, for to mark out where my liquidity is and where there's a strip of liquidity. This is what I use. These are the icon that I use. These are the icon that I use. So now, if you want to hide all your drawings, this is the icon that you use. Maybe you are looking for, you want to draw an analysis for someone and you want to just cover some things, you just hide it. Or maybe you want to see clearly after doing your analysis, you just want to see the plain charts. You can just hide it. Everything is going to be hidden. And that's it. That's it basically. That's it basically. So I think with this, I think I'm done with the class. I think I'm done with the class. So you can just drop your question in the next 2 minutes so I can answer your question and then pass the call to the next educator. All right. Since there's no question, so I'm going to pass the call now to the next educator. So just sit back and enjoy. It's getting more deeper and more interesting and more fun. All right. Okay. So Coach Philip, you are now the host.
All right. Thank you, Ayo, for that section. Thank you. That was awesome. Thank you. Thank you. Thank you. So, guys, don't worry. The call is going to be dropped on the YouTube channel in case it was too fast or there was some things you really didn't understand. You could just watch over and over and over and over again. So I know some of you are like, okay, explain just two candles. Like, how is it that you're saying there's two candles? What about the shooting star, the pin bar, all of this good stuff? Well, the idea is just the idea. Every candle has a close, has an open, has an high, and has a low. Once you can know all of that in a candle, you are good. And probably because of the way we trade, we actually trade smart money. Not necessarily that we ignore all of those rejections and weak, but we trade smart money. We follow the market. And I'm laughing now because my coach is using his video is on and he's staring directly at me. So guys, without wasting so much time, I'm going to pass it on to the next host. And trust me, I think this call is about to start getting a whole lot interesting. So Ayo is going to be the next. It's amazing that the two people teaching today, the two educators, their name is Ayo. So don't worry, we are going to the market structure training now and the support and resistance. So Ayo, my G, you're now the host. Thank you for having me. And yeah. Hey. All right, sorry about that. That's network-ish. That's network-ish. So, Aya, you are the host now, and you can proceed.
All right. Good evening, everybody.
Good
You can hear
evening.
me? The chat. Drop something in the chat, everybody, please. You can hear me clearly. You can hear me clearly. All right. Okay, let's go. You can hear me. Keep dropping. All right. So, thank you. Before I proceed, I would just like to shout out to my Coach Philip, and to his coach also, Coach Tony, and to every coach that is on the call. So welcome, and also to my audience. Good evening, everybody. Good evening. So next, I'll be teaching on something very important, something you need to know, something you need to be familiar with. You want to be a good trader. So let's go. So I'll be sharing my screen now. So, all right, can you see my screen? Can you see my screen? You can see my screen, please let me know. Drop something in the chat so you can see my screen. Drop something in the chat so you can see my screen. All right. So these are the things I'll be treating tonight. These are the things I'll be treating tonight. The first thing I'll be treating is market structure slash identifying trends. Market structure and identifying trends. So just follow my slide carefully so we can make it fast. And also, no way, you don't need to screenshot anything. When the video gets uploaded, you will see everything. All right. So what is structure? It is market structure. We are looking into the market, but then for you to know what market structure means, there are many structures you need to know. There are many structures, but our focus tonight is the market structure. And what structure simply means is a composition or formation of a thing. It means a composition or a formation of a thing, meaning we can have a structure for anything, like the structure of a human being, we can have the structure of a car, we can have the structure of anything at all, anything at all. For example, if I say what is the structure of a car, you want to give me some things you find in car, right? What the car is made up of. You say the radiator, the car's steering, and all of that, and all of that. So what is market structure? What is market structure? Market structure is the framework or structure that any given market is currently trading in. Market structure can help you understand the behavior, the conditions, and the current flow of market. It highlights the support and the resistance levels, swing highs, and the swing lows. So what am I trying to say? I'm trying to say that the market structure is everything that the market is everything that the market consists of is what the market structure is. And when you open the chart, you just see some lines, like people call it, they'll say they're just in lines. Now, for you to understand those lines, you have to understand market structure. So, market when you open the chart, you see lines going up, some might be coming down. This is what you see in the market, basically. This is what you see in the market, and this is the composition of the market or the formation of the market. So, having understood what I mean by market structure, can we move on to the type of structures we have? Sorry, type of market structures that we have. Number one, we have the bullish structure, we have the bearish market structure, we have the consolidating or the ranging structure. I know most of us we are familiar with um, calling it the buying trend, the selling trend, the ranging or the sideways trend. So this is just it. It's just a term I'm using. So we have the bullish market structure, we have the bearish market structure, we have the consolidating or the ranging market structure. What is the bullish market structure? I have here on my slide that the bullish market structure is identified when series of higher highs and higher lows are created or formed. It is identified when series of higher highs. The word series is very important. Meaning, you can see this diagram over here. See this diagram over here, right? So um, we have the market going up, came down again, went up, and came down and went up again. Now, it is picture perfect here, but this is not what you see in the chart. It will be, it will be very confusing sometimes. But then, basically, this is how it looks like. This is how it looks like. All right. Meaning, when the market is bullish, it means the market is buying, meaning it is a bullish trend. The trend of the market is bullish, meaning it is buying. The candles you'll be seeing is like the previous indicator taught us that when you see the green candle, it indicates a buying candle. right? When you see the red candle, it indicates the selling candle. But in a bullish market structure, in a bullish trend, what you'll be seeing is a green candle. Now you can have red candles in between, but when you see the overall trend, when you check the overall trend of the market, of green candles in the market, right? All right, so let's move on. Uh, so this is just a typical chart of a bullish trending market. You can see the markets going up, going up, going up, going up. Now, in this chart, don't be confused. Don't worry, don't be confused. You are not seeing green nor red. I know. But you can use any color you like. You can use any color you like. Like my chart now, I prefer using the white and the black. If I see a black candle telling me the market is what? Market is buying. And if I see on this chart now, you can see the black candle and the buying candles, the white candle are the selling candle. So you can see the market creating series of higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows, higher high, and so on and so forth. Now, why we use the term higher lows, higher high is just simple. It's a simple thing. Now, you can see we have this eye here, like Coach Ayo said, that you identify the eye of the candle, you identify the low. Now, in a trending market, you want to see the high and the low. If it's a selling um, trend, you want to see series of lower lows and lower highs. If it's a bullish market, you want to see what? Series of higher highs and higher lows. So it is a bullish market. Now, why this thing? Why we say it is higher highs and higher lows? It's just simple. Like you can see this high here, you can see this low here. Now, if you are going to check this high here, you discover that this high is higher than this high. You can see this eye is higher than this eye. That is why we call it higher eye, meaning it is higher than this one. If you check this low here, higher low here, and this higher low here, you discover that this low is higher than this low. That's why we call it a higher low. Are we following? If you get that, can you drop some hits in the chat? If you get that, drop some hits, drop some hits. Come on, guys, drop some hits in the chat. Let me know I'm talking to people, please. Let's go, let's go, let's go. Drop some hits in the chat. All right, all right, all right. Thank you, thank you. So you can see higher high, higher low, higher high, higher low, higher high, higher low, higher high. So this means the market is currently what? A bullish trending market. The market is trending upwards. The only thing you want to do in this market or focus on is a buy because it is a buying market. All right. So let's move on. Let's move on to the next thing. So we have the bearish market structure or the selling market structure, meaning the current trend we'll be looking at now would be a selling trend. So I have here in my slide that the bearish market structure is identified when series of lower lows and lower highs are created or formed. We validate a lower low when a new lower low is formed. Now I'll explain that, but then let's go over it again. All right, just vice versa what we do for the bullish market structure. So you can see the market going down and go up. Now when you check this low and this low, what do you see? And someone tell me, what do you see? Why is this low lower low. And why is this lower low? Why not this is a low and this is a high? Assuming this is a high and this is a low. Because it's a selling structure, remember you want to see series of lower high and lower low, right? So why is this lower low? Can someone tell me? I explained earlier. Can someone drop it in the chat, please? Okay. So someone said because it is lower than the first low. Exactly. Because it is lower than the first low. That is why it is a lower low. Thank you for understanding that. So you can see a lower low, a lower high, like that, like that, like that. That is how you see it in the market. That is how you see it in the market. And when you see this kind of thing, what you just know is this market is a downtrending market, meaning it is a bearish market. And what you want to be looking to do in the market at that time is what? Is to sell. Is to sell. Why? Because we have more sellers in the market than buyers. Okay? Okay, so let's move. So you can see here in the chart, you can see here in the chart, we will go into the live chat, but then just follow me carefully. You can see the market going downwards and also went up, went down, went up, went down, went up. Now, like I said earlier, for every starting point of a trending market, all you see first should be a high, you've been taught, should be a high, and what? A low. That's the first point, the first structural point you want to see is a high and a low. Be it a buying market or a selling market, what you want to see is a high and a low. And then the next swing point will determine if the market is buying or it is selling. If the trend rather it's a sell trend or a buying trend. So here what do you see? What do you see? What do you see? After the high and the low has been established, what did you see next? Don't drop it, please. What's the next thing you saw? Or you are seeing rather? Okay, someone is asking a question. A bearish market, is it a market to buy or sell? A bearish structure is a selling structure. Okay, a bearish market structure is a selling market structure. Okay, you don't want to focus on buying, you only want to focus on selling. Well, some people buy in a selling market structure, but then you understand why they actually buy in a selling market structure later. We'll teach you that. But for now, I just wanted to know this first, that in a selling market structure, the only thing you want to do is what? Is to sell. Do you understand? Do you understand, sir? Ogene Ovie, do you understand? Should I move on? All right, I think he's busy or something. So, all right, so in this structure, what do you see? You see a lower low, you see a lower high, you see a lower low, you see a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, a lower high. You just keep seeing series of lower lows and lower highs in a bearish market structure. If you understand, can you drop it in the chat? Let me see, let me see, let me see, let me see, let me see. Drop some eight, drop some eight, drop some eight. All right, cool. Let's go. All right, so moving on, we have the third type of market structure we have is what the consolidation or the ranging market structure. Some call it the sideways market structure, meaning the market is not doing anything apart from going sideways. The market is just going sideways. It's creating highs and lows in the market, but what it's creating are equal highs and equal lows. So let's go to the definition. It says the horizontal movement of price, the horizontal movement of price shown by equal highs and equal lows is called a sideways trend or sometimes referred to as chop. Now, when I started, then I really didn't know much about market structure. I didn't know market structure actually. All I knew was support and resistance, and we go into the chart and we just look for support and resistance. We see when we see chart like this, chart creating this kind of thing, like it's just going sideways. We just believe we have this um, we have this in the market, and we say we sell at what? We sell at resistance and we buy at support. This is literally what we used to look at. But if I understood market structure, then I will discover that this is just a type of market structure, and there is a way to trade this. Now, um, okay. I will show us when I open the live chat. I will show us the equal height and the equal low. Meaning the market are just going what sideways. If it's in a bullish market, you're seeing the market just going sideways. If it's in a bearish market, you're seeing the market just going sideways. Before the market decide where it wants to go, is moving sideways. When you see this, you know this is a ranging market structure. This is a ranging market structure. Okay, having understood that, let's go. So, okay, before I do support and resistance, what I have next is let's do a break of structure first. Then I'll come back. Let's do a break of structure. Then I'll come back to support and resistance. So, what is a break of structure? What is a break of structure? What do I mean? What do I mean by break of structure? The break of structure gives us the first clue that the market is about to get weaker or it's about to reverse. How do I mean? If the market is an uptrending market and you see a reversal like this, you can see this reversal. The market actually reversed back down, okay, and broke this last structural point. Now, how do I mean? You can see this market going up, forming series of what? Higher highs, higher low, higher high, higher low, higher high. Now, this was the last higher high, and we have this higher low. If I entered into the market when I've not seen all of this, if I've not seen all of this when I entered into the market, I'll say, okay, the market is what? A bullish market. But then immediately I see a reversal like this or a shift. Some call it a shift in momentum. When you see this kind of shift in the market, all you just want to know at that point is that the market just broke structure. Meaning the last strong point, which is the higher low, has been broken. And the market is um, trying to go downwards, meaning the market is trying to change trend. It's trying to change direction. Okay, in a bearish market, okay, this is just the chart. Also, you see higher low, higher low, higher high, and you see this break of structure. Why? Because there was a change in direction. You can see the market went up. This was the last higher high, the last higher low. And what did market do? Market did what? Broke structure. It broke structure here. And you can see it. You can see. You can see how the market rallied down and broke this last structural point. Once you see this, you just know the market is trying to change direction. And once the market changes direction, the next thing you want to see the market do is what? In the bullish market, the next thing you want to see it do is what? Start creating a series of higher, lower high and lower low, meaning the market has changed into a bearish structure. Do you understand? If you understand, drop something in the chat. If you understand what I just thought now, can you drop something in the chat? Drop something in the chat. Drop something in the chat. All right. Okay. All right, we understand. Thank you. So let's move on. All right. Since we understand a break of structure, we understand the break of structure now. Let's go back to support and resistance. Let's go back to support and resistance. Just stay with me. You're going into the chat soon so I can show you these things on the light chart. All right, so support and resistance in the market structure. Now, what is support and resistance? I know they have told you to buy when you see the market in support zone. These are zones in the market. When you see it at the support zone, what do? You buy, right? Okay. When you see it at the resistance zone, what do? You sell. Jesus. All right. I'm laughing because this thing taught me lesson. It taught me well, and I actually learned from it. So what is support and resistance? It says price movement is often restricted within the limits of support and resistance level. Price can cross these levels and shift to other areas of support and resistance. Okay, so what is a support? A support is a price level that can out a downward due to a concentration of demand or buying interest. You see, a buying interest. Support levels usually contain a numerous amount of buy orders in the order booked from major market participants. What am I trying to say? Now you can see this diagram. You can see this diagram. You can see this diagram. You see this resistance zone. You see this support level also. Now, when we say the market is at a support zone, what do we mean? We mean that what we actually mean is that the market is bouncing back. When the market gets to a particular place, it bounces back. You can see the market came here, it bounced back up. The market came here, it did what? It bounced back up. The market came here, it bounced back up. Okay, why? Because this place is a support zone that it is very strong and is making the market go back up. It is making the market go back up. When you see this kind of thing, you want to buy. You want to buy. It means the market is actually still buying. Why? Because this place is actually supporting the market to go up. And if it is a resistance zone, what do you want to see? You want to see the market go to the zone and what? Come down, go to the zone and do come down. Okay, I'll show us. So, what's the definition of a resistance? It says a price level that repels an uptrend due to the emergence of an increased number of sellers. Resistance level contains a high volume of sell orders in the order book. Now, this is a chart. This is a chart. Now you can see zones here that has been allocated for you. You see a zone here also. You see a zone here also. Now, carefully, let's look this together. If we name this a support zone, meaning what we want to see when the market comes here, if it does not break through, it will do what? It will bounce back. If the market comes again, like the market came down there, it didn't break through, it did what? It bounced back. It came back, it tried to break through, but then it was a false break, it went back, it came back, it went back. You see how it kept on bouncing back, kept on bouncing back. Now, if it is a resistance zone, you can see the market going up and it's bouncing back when it gets to that resistance zone, it's going up, it's bouncing back when it gets to the resistance zone, it's going up and it's bouncing back like that and like that. You want to see these things occur in the market, and when you see these things in the market, you want to draw out your resistance zone and your support zone. Okay, so the next thing you want to see in that market is a bullish market. You want to see the market break through. You want to see the market break through. You don't want, I said you can see this is consolidating. It is a consolidation or consolidating market. That's why it is just going sideways from year to year, from year to year. It's just sideways. It's just a consolidating or ranging market. So in that kind of market, it is a bullish market. You want to see breakthrough, then okay, no worry, you'll be taught because we don't trade equal heights, we don't trade equal lows, we don't trade support and resistance like people trade all of those things like you buy at support and sell at resistance. Trust me, you only just only go, you only go. Eh? So don't worry, you learn a lot. You learn a lot. Okay, so and also permit me to add this to knowledge. There are two type of support and resistance zone. We have the static support, we have the static resistance, we have the um, dynamic resistance zone, we have the support resistance zone. This is a static, this is a typical example of a static resistance zone. You can see the market is coming back up. It's not breaking through at all. It's not even breaking through. You can see it here also till it broke through here. Focus, focus here. You can see the market just coming and bouncing back, coming, bouncing back. This is the static resistance zone. Now let think we have this. Should I use this? No. Let me just show us in the chat. Let me show us. Let me show us in the chat. Uh, Let me show us in the chat. Please bear with me. All right. So this is my chart. Um, sorry. Let me just clear all of this. Let me clear all of this. All right. All right. So this is a plain chart. This is a plain chart. So what do I mean by a dynamic resistance and support zone? This is what it looks like. This is what it looks like. This is my trend line. This is my trend line. Only just bear with me. Okay. Let me just leave it here. So let me leave it here just to show what I mean. Or let me see if I can see. Okay, I think let me use this. Let me use this one instead. Just stay with me, please. Stay with me. I'm trying to show us what the dynamic resistance and support is. All right, just drop something. So this is how a dynamic looks like. Dynamic resistance and support. So meaning the market is actually trending. The market is trending. But then why the market keeps trending is making the higher low and higher high and it's coming to that trend line and it's bouncing back down. When it gets to the trend line, it's towards it bounce back up. When it gets to the trend line, it's bounce back up. It's not like static resistance zone that is just going sideways like this. Exactly. Something like this. It's not this one. It's not this one. It's not this one. You see the difference now. You can see the difference. This one is going sideways and once it gets there, it bounces back up. Okay, so if you understand that, can you drop some hits? Drop some hits. Drop some hits for me, please. Let me be sure. Alright. It's really coach really that understands that. Okay, okay. Let's just move. Because of time. Okay, so let's go. What's the next thing? So the next thing I'll be speaking on is the Fibonacci retracements and extension tools, the Fibonacci retracements. And when Sayo was teaching, he mentioned something about this tool. You can see all the tools on the chart where he was bringing out the Fibonacci tools and he was drawing it and was explaining how that you can change the numbers you want. Now, this is the Fibonacci retracement or extension tool. He says that this is a tool used in recognizing the premium or discount zones or levels of a particular range in a trending market. For example, we have a bullish market. If we have a bullish market, in a bullish market, what do we want to see? We want to see higher highs and higher lows. Okay, we've not learned what range means, but then let me just show us something. Let me show us something so you can understand what it means. Uh, sorry. I don't know why this thing is not coming up. Okay, let me just sorry, please give me some minutes. Okay, let me use this. So we say this is a bullish market, right? So it means that in a bullish market we have higher highs, higher lows. Meaning this from this place, from this point, this higher high to this higher low is a range in the market. From this higher low to this higher high is also a range in the market. This higher low to this higher high is also a range in the market. From this higher low to this higher high is a range in the market, right? So if you want to use your Fibonacci retracement tool, it's just saying that the only time you can use the Fibonacci retracement tool is when is within a range in the market, in a trending market. If we have a bullish trend, meaning we want to draw from the swing low to the swing high. We want to draw from the swing low to the swing high. So um let's see. Okay, this is a tool used in recognizing the premium or the discount zone or levels of a particular range in the trending market. 50% and above is known as premium zone, while 50% and below is known as discount zone. Now I'm just going to take the because the next thing I'm going to teach is the premium and the discount zone. So I'm just going to explain it here before going to the chart. So the premium zone, what are premium zones? Premium zones are if you're in a bullish market, if you're in a bullish market like I showed you, within that range, you want to buy below. You want to buy below. Meaning you wait for the market. Let's say this is the trend, this is the last range. Let's say this range has not even occurred. This is the last trend. This is the last trend of the market. Now, if you are using the Fibonacci retracement tool, what you want to do in this particular range, you want to draw your peak level from the swing high to the swing low, right? And you want the market to retrace back down. You want the market to retrace back down to a premium level before you take it back up. How do I mean? Now, take for example, you want to buy an iPhone or Samsung. No, an iPhone because iPhone really drops in price. Samsung will just start it. I don't know. So if you want to buy an iPhone, let's say when iPhone 13 came out, it was I think like a million point something naira. I don't know. Now, would you rather buy for 1 million naira, or you wait for it to come down, like come down, drop in price before you buy it? Now, people that has the money bought it. I don't know, some people wanted to show up, some people needed the phone, some people wanted an iPhone 13. But for me, I would want the price to drop before I will get it. Meaning, I will want it to drop to a premium level or a discount level for me to get it. Okay, so if it was 1 million naira, I'll be waiting for it to drop to like maybe 600k, or I think it's currently 600k. Maybe it's 13 like 600k or something. I don't know. But you want it to drop in price to a discounted zone or a premium level for you to buy it. Now, a person that bought his own for 1 million naira and you buying your own when it drops in price for 600k, who is more wise? Now, I know, you say it's not about being wise, it's just the person has the money and bought it. Fine. But if you have to look at it from this perspective, you discover that you are wiser than that person because you waited for it. You waited for it to drop in price, and you could have used your 400k, your extra 400k to do something else, right? So this is what we are explaining here: that a premium zone or a discount zone, you want the market to come back, okay, to come back to that discounted zone or that premium zone before you take the market back up. So if it is a bullish market, all you want to do is to wait for it in that range. After it has created higher high, you want to wait for it to come back to that zone for you to that discount zone for you to take it off. Can you see my screen? Can you see my screen? Please, can you see my screen? Please let me know. Oh, you can see my screen. Wow. Hey, I'm coming. I'm coming. Can you all see my screen now? Can you see my screen? If you can see my screen, please let me know. Okay, you can see my screen now. Some people can see it. Some people, okay, when I started talking about static and okay. But you understood what I was trying to pass across, right? Did you understand what I was discussing earlier? If you understand, please let me know. Let me know before I move on. Okay, you don't understand. Okay, some people understood, some people didn't understand. Okay, you know what? Let's just go to the chat then. Let's go to the chat. I'll just show us everything. Everything I've thought about, I will show us on the chat. I will show us on the chat. Let me remove this thing. Okay. All right. So we started from what is market structure, and I discussed that everything here is a composition of the market, formation of the market, right? And we said there are three types of market structure: the bullish market structure, the bearish market structure, the consolidating, or the ranging market structure. Now, this is a bullish market structure. You can see the market just trending up. You can see the market is just trending up, right? From this point, from this point, from this point, you see the market trending up. You see the market trending up. And when the market is trending up, what do you want to see? You want to see series of higher high, higher low, higher high, higher low, higher high. Now, when you want to, if you want to check this well and you want to see it well, you would, I recommend a line chart. Check through a line chart so you can see well. So you can see well. I'm change my time frame. Sorry. All right. All right. So this is it. This is it. You can see from this point, you see the market. Just something like created higher low. I mean a low and a high. And the next thing we saw is what? A higher low, higher high. And see from here, so we see higher low, higher high, higher low, higher high, higher low. Like that, like that. So if you see this kind of thing in the market, you know the market is trending up. Market is trending up, right? So let's check for a bearish market structure. Now this thing you should not see, the only way you can know this thing is if you continue looking at the chart. If you continue looking at the chart, you have to practice this thing. Because you are taking what we know in 5 days does not mean you will know it. Okay? It's left to you to go and practice. It's left to you to go and practice. Okay, once your eyes can see all of these things, you would have less problem trading. So this you can see the market trending downwards. Market is trending downwards. And in a bearish market, what do you want to see? You want to see a series of higher and lower high, lower low, 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 and so on and so forth, right? So this is a live chart, saying it if it's a consolidating market, let's look for a consolidating market. Just try to backtest this thing to see everything. Look at it here, the consolidating market. See the market just going sideways. Market is just going sideways until it's what it decided on where to go to. So the market kept on going sideways, kept on going sideways, kept on going sideways. This, like this, like this, this, like this, like this, like this, like this. Now, in this kind of market, you just want to watch what the market is doing. You want to watch what the market is doing until it decides. Because, like my coach will say, you say this is just a choppy market. I'm not saying anything in the market, so I'm off the market for now. You just want to stay off the market until the market decides. Because what you want to trade in a clear chart, so you don't just waste your money. Okay, so remove everything. The next thing is the break of structure. The break of structure. Now we can see this market trending upwards. This market is trending upwards, right? And this series of higher highs and higher lows until something happens. Until something happens, you see that it got here and the market couldn't go up again. It got to this point. It got to that point and the market started reversing. The market started reversing. Let me zoom in so you can see. You can see it got here and the market started reversing. Now, here was the last point, the last higher low we had. was here. Last higher low we had, and this was the last higher high, right? Then the market reversed, and came all the way down, and the market broke. Yeah, that's you see how the break of structure, the break of structure. The market broke structure and did what and reversed and it started going downwards. It started going downwards. Started going downwards. Started going downwards. It got to this place again. What did the market do? You can see a lower low, a lower high, right? A lower high. This low is lower than this low. A lower low, right? And what did the market do again? The market changed direction. The market changed direction. Now, when you are considering a break of structure, when you are considering a break of structure, please always consider the body of the candle. What do I mean by the body of the candle? When Sai was teaching us, we talked about the body and the close, the open and the close of the candle. Now, this is the body of the candle. You can see this. Use this. Yeah. This is the body of the candle. This is the body of the candle. And this, now you don't want to consider the week. Don't consider the week, just consider the body. Okay, that's why I drew my break of structure from the body, not the week. Right? Because sometimes market can just come and just sweep liquidity and reverse back, and you think it's a break of structure. No, it's not a break of structure. It's just what the big banks are using to like fill in their orders before going or before changing directions in the market. Oh, sorry, before continuing in the major trend, not changing direction. So what you want to see for a break of structure is that the market actually breaks the body of the candle and see all of this body here and win. Alright, so because of time, let's move faster. Let's move faster. Support and resistance. Support and resistance. Wow. Let me just draw the support. This is the resistance zone. Let me make this red. As a resistance zone. Also, say this is support. See, when the market came up here, it bounced back down. It went back up. It came down again. And broke through. It was a break, false break. It did what? Went back up. And also, the market broke and kept on going up. You know, kept on going up. It kept on going up. And it was just doing its thing. And the last resistance zone became the last support. Became the next support, rather. Became the next support. And when the market comes, it buys. When the market comes there, it bounces back. And just like that, just like that, just like that. And the last thing I thought was what? The um, Fibonacci retracement. Fibonacci retracement. I want to first identify my trend. Let me just use this. See, the market is trending downwards. From here, the market made high, made a low, then broke structure here, So yeah, and did what? He retraced and came back down. Now, because the market broke structure here, what I'll be looking to do is to sell at a premium zone. When it is in the sell trend, you want to sell at a premium zone. When it is the buying trend, you want to buy at a discount zone. So I'll bring up now Fibonacci tool and draw, sorry, from the swing high to swing low, right? Now, when the market came, you can see above any zone above the 50%. This is my 50% here. Any zone above the 50% is a premium zone. You can see the market came into the the 0.618, then the market bounced back. Now, I bought at a premium zone. Why? Because it was above the 50%. It's a buying market. It's a buying market. Where can I use? All right. I just use my best. Okay. So the market retraced here. Retraced here. I see a low, high, low, high, then no, a lower low, a lower high, a lower low, and market broke structure here. Now, when the market was retracing back, when the market was retracing back, I want to buy here on a discounted zone. It came down and even touched beyond it. It was below the 50%. You see the 50% here. You see the 618, the 786, and put the 86 if you want. Just know all of these zones are what they are the discount zone, and this is where you want to sell. I mean, this is where you want to buy rather. So the market came down well and rallied back up. Okay, okay. So let's just finish our slide. So this is what I'm showing us in the chart. You can see the premium zone, you can see the discount zone. If the buying market wants to buy at the discounted price, if the selling market wants to sell at the premium zone. So you see how to use the Fibonacci to retracement. I just showed us on the chart. I just showed us. You can see the buying market, to draw your chart, draw it. So drawing Fibonacci retracement level is a simple three-step process. In an uptrend, step one, identify the direction of the market uptrend. Step two, attach the Fibonacci tool on the bottom and what? And drag it to the right, all way to the top. Okay, vice versa uh, it's just the other way around in the downtrend, right? So you can see the diagram here also showing us how we use the Fibonacci retracement tool. So when coach upload this uh, video, you have this slide, so you can just go through it and open your chart and look into all of these things. Look into it and keep practicing, keep practicing, keep practicing. Comes to the end of the teaching. Do we have any question at all? Do you have any question on what I just taught? You can please ask now. And please ask your question on what I just taught. Do you have any question? All right, I think we don't have any questions. So I'll be passing the host to Coach Philip. Please share one light on the feed. On the feed. All right. I said the feed is Fibonacci retracement tool is a tool you use in the market Like if you want to buy, let's go back. Let's go back.
This is a tool. This is a tool used in recognizing the premium or the discount zone slash levels of a particular range in a trending market. 50% and above is known as a premium zone, while 50% and below is known as what? A discount zone. This is it. Premium zone, if it's in a selling market, you want to buy at a premium zone. If it's a buying market, you want to buy at a discount zone. Okay, so and this is just how to draw it. These are the steps to drawing your fib levels. It says drawing Fibonacci retracement levels is a simple three-step process. In an uptrend, now I just removed the last one because it's just the last one is like changing your numbers. If you want the 50%, if you want the 886, if you want the 716, you get if you want the 618 there, just make sure it is above the 50% if it's in a selling trend, and it is below the 50% in a buying trend. Okay, so you identify the direction of the market first. Let's know if it is a uptrend or a downtrending market. So if it is an uptrend market, like I said earlier, you want to buy below the 50%. Okay, if it's a selling market, you want to buy above the 50%. All right, so in a okay, I've explained both. So I hope with this you understand now that you you actually use the Fibonacci retracement levels in you use it in a trending market and within the range, the current range, the particular range you are looking to execute your trade. Okay, so the last swing point will be where you withdraw your Fibonacci tool retracement. All right, and lastly, I would like to tell us that the for checking the overall trend of the market, you use the H4. Use the H4 for checking the overall trend of the market, the H4, the daily, the weekly, just the higher time frames. Ignore the 1 minute to check the overall time frame. No, don't use the 1 minute. Okay, use the higher time frame. All right. So do we have any other question? Any other question? All clear, all clear, all clear. Do you have any other question? No question. So coach, I'll be passing the post to you now. Coach Philip. Hey.
Coach.
All right, sorry about that break in transmission. Sorry about that. Thank you so much. At Sunday, every day. Thank you. Thank you. That was a nice one. All right, so let me quickly answer this question. I think I attended to it, but let me quickly show you with my chart. Let me share my screen. Okay, that's my trading view. Let me look for a clean chart. Okay, let me look for a pair. All right, so the question says, okay, at Mr. Daniel Sunday, please explain for the bullish and bearish how to use the fib from the top to the bottom or from the bottom to the top. Okay, that's quite easy. So for example, wow, good. Now, this is looking at this is a bearish market. Like you said, the first thing you want to identify is your structure. So this is like the lower high and then like the lower low, right? So you want to bring your Fibonacci tool out. So for a bearish market, you want to pick it from this very high, right, to this very low, and then you want to be buying at a premium zone. Remember, for a bearish market, you want to be buying at a premium zone. You understand that? So from 50% and above is a premium zone, like you said, and from 50% below is a discounted zone. So in this condition, being a bearish market, you want to be buying at a premium zone. So you want to be buying at 50% and above. You understand that? And then for us, because of the way we trade particular fib zone in which you are going to be going over tomorrow. So tomorrow promises to also be awesome. So that's for a bearish market. And then I would like to clean this, and then so I don't waste so much time, I would like to flip this chart. So because this is now a bearish bullish market, meaning this is the higher low and this becomes the higher high. So you want to pick your Fibonacci retracement tool. You want to pick from this low and then to the high, right? And then you want to be buying at a discounted zone, which is 50% and where and beyond. That's where you want to be buying from. And you can see in this instance, it got to the, let me say, I think this should be the 78.6, and then price started retracing to the upside. So basically that's how to use your Fibonacci retracement. All right, and then it went over your market structure. I believe I don't need to recap on that. It did a thorough good work. So for every single educator today, thank you. For every single person that joined, also thank you. All right, so I and my guys were discussing some while the call was on, and because of the call we have tomorrow is actually the main juice. Having understood market structure and understanding how to use the trading view and all of those things, tomorrow we are going to be starting with the range, the liquidity, This basically the smart money concept is what we are teaching on tomorrow. So because it covers a lot, we are looking at having two sections. I don't know if it would be cool with you. You know, some people work, and then some people they have the time. So how do you, what do you think we should do? Are you cool with the two sections? We are going to be having the first section in the afternoon, probably around 12, and then 12 noon, and then probably the second section will be our normal 9 o'clock. But if you are still cool with the 9 o'clock, one section per day, then it then means the call might probably extend to next week. So I don't know. Okay, someone is saying we should use a different day. All right, so I believe what we just do is we just continue with our 9 p.m. Anywhere we stop, we'll pick it up from there. So don't worry, no problem at all. So guys, thank you once again for joining. The recording is going to be dropped on YouTube. Please, when you are downloading, try to like, try to comment, and try to subscribe. Thank you, thank you, thank you. And lastly, please, for your friends that are not on the call, do well to make sure tomorrow they don't miss. I really just hope nobody misses tomorrow's section. Tomorrow is the source. Trust me, tomorrow is the source. So I'm not still teaching, right? I'm teaching probably, no, I'll teach, but not tomorrow. But I'll run psychology tomorrow. So please invite your friends. The person teaching tomorrow is prepared. I know he is prepared. Trust me, how do we call him now? I wish I unmuted the mic for everybody. I've heard a lot of noise from my guys. But the person teaching tomorrow is the billionaire. So please, I'm really begging you. The bootcamp is free, but please make sure you invite your friends. I'm expecting not less than 150 members on this call tomorrow. So please invite your friends, talk to people. The group chat is active. Try to engage so that we can have a whole lot of people on the call tomorrow. So without wasting so much time, I want to again say thank you to everybody and to my mentor, Tony Blair. Thank you, coach. Thank you so much for the opportunity. Thank you for the impactation. Thank you for the knowledge. I am grateful. And to everybody, have a wonderful night rest. Cheers and God